All right, well, let's take a closer look at what is happening with big tech stocks. Angelo is Vice President and Technology Equity Analyst at CFRA in New York. Angelo, thank you so much for joining us. So we are seeing that stock markets globally have taken quite a hit. Tech earnings are also mostly, not completely, down. What is your analysis on what actually is going on with big tech at the moment?
Yeah, so thanks for having me. So as far as kind of, what we've seen thus far during Q2 earnings season, I would say execution from big tech has been pretty good. It's been a little bit mixed in terms of certain business lines kind of beating or missing, but for the most part, these companies have executed very well in the face of the fact that, comparisons have gotten definitely a lot more difficult. And are expected to get a lot more difficult in the second half of this year. So all eyes were kind of on the guidance and whether or not they can kind of meet some of those higher expectations out there. So, that said, it's not necessarily a surprise that we're starting to see some multiple compression during this earnings season. If you kind of look at tech overall, down about 14% from peak in early July to intraday today. Semiconductors, which was the biggest component within tech, down about 24% from peak to trough over that time period. So we've seen a really nice correction at this point in time. And when I think about kind of big tech overall, there's really kind of two key drivers, for most of these mega cap names. One is digital ad growth. That's, clearly a big driver for names like Alphabet, Meta, and even Amazon. And then the other second big trend out there is the cloud. And both those trends continue to grow very healthy. It's just the fact that, some might be kind of just slightly missing expectations, like on Microsoft with Azure on the cloud side of things. But still, the trends remain very healthy overall going into the second half of this year.
So in fact, most of the big tech companies are investing heavily in AI. Microsoft, Alphabet have seen their market cap fall. NVIDIA also hit somewhat. The question, I suppose, is the AI hype. Is it beginning to cool? Have some of these companies over-invested?
Yeah, I mean, I wouldn't say they've over-invested at this point in time, but, I will say that there was definitely some kind of elevated multiples, or the multiples kind of definitely got a little bit ahead of themselves because of some of the AI enthusiasm that is out there. Again, part of the reason why we've seen some of this pullback here. But as far as kind of the CapEx spend is involved, we kind of look at things a little bit differently here than maybe others out there. If you kind of actually look at the CapEx environment from the 6 biggest spenders out there over the last 6-7 years, CapEx spend has actually more than tripled over that time span. And a big reason for that is the free cash flow of the biggest market cap companies out there continue to significantly improve because of some of those, secular trends I talked about, digital ad spend, the cloud, and what have you. As we kind of look here into 2024 and into the 2025, our view is you're going to have higher CapEx spend next year versus this year, and 2025 won't be the peak either. As long as the fundamentals for these mega cap companies continue to improve, that should bode well for higher cap spending in future years to come. So, that said, nothing is kind of a straight line up and to the right, but nonetheless, the companies that are kind of seeing the greatest content growth out there, like a company like NVIDIA and an AMD, we think will be significant beneficiaries, not only over the next 12 months, but over the next 3 to 5 years.
All right, thank you so much, Angelo, Vice President and Technology Equity Analyst at CFRA.